Lately, 5G technology has received some pretty bad press related to some unfounded links between 5G mobile connectivity and the whole medical issue, but regardless of any of that, 5G technology is being rolled out worldwide with some talks of amazing functionality. So let's speak about how you can maybe get in on some of this action through stock market investing. Hey, what's going on, savers and investors? I hope you're all having a great day. If you're new to the channel, then welcome. My name's Griffin, and in today's video, we're actually going to be taking a little break from the company specific Q1 analysis videos. I know those have been really popular with the audience, and I have quite a few more planned out in the coming weeks. However, today we're going to be speaking about a couple 5G stocks that you might want to keep on your radar if you want to have some exposure to 5G technology being rolled out in various different industries in the coming years. Now, before jumping into these 5G related stocks, let's speak about what 5G technology even is and why it's going to impact some companies more than others.
Simply put, 5G is the fifth generation of mobile networks, which has the goal of achieving a higher level of interconnectivity and speed between devices, cars, machines, and pretty much anything else we want to connect to the Internet of Things. It's the next generation of network connectivity following 1G, 2G, 3G, and 4G, which we're currently using and accustomed to, and 5G is going to be a massive game changer for several industries, offering capabilities that would have never been possible prior to 5G, with implementations already taking place in cell phones most specifically, but will also have a huge impact on transportation, gaming, medical practices, and the list goes on. Now, from an economic standpoint, what type of impact will the rolling out of 5G produce worldwide? That's definitely a question that has a major impact on why any of this is relevant in the first place in relation to stocks and companies that would be expected to grow from this new technology. Well, the impacts are going to be major, with an expected $13.2 trillion of newly created global economic output, 22.3 million new jobs, and $2.1 trillion in GDP growth, which, let's be real here, are huge figures that are highly beneficial for the global economy. And if you want to have some exposure to this new tech boom rather than being left behind, then investing in some 5G related stocks could be your ticket to achieving that goal. So in today's video, we're going to be covering two different stocks that are involved in 5G, either being a telecommunications company or an actual 5G component manufacturer. And these two stocks are in Canada and the United States, since actually most of these 5G stocks are American. And the reason why we're only going to be covering two stocks, even though we could speak about a handful of them, is because we're going to be diving into the balance sheet, income statement, and cash flow statements for each one, which makes the video quite hefty with a lot of information to take in. Alright, so diving into the first stock we're going to be speaking about, this is an American company called Qualcomm that specializes in the creation of semiconductors, software, and services related to various wireless technology. And as you could guess, they have direct interest in 5G technology by supplying 5G wireless connectivity chips for phones, tablets, vehicles, and any other device that will be using 5G technology. So for a company such as Qualcomm that is a direct manufacturer of the components that will enable 5G devices, this puts the company in a great position to benefit firsthand from the 5G boom that is just starting to take place in its preliminary stages. Qualcomm is already selling their Snapdragon 5G chips to certain cell phone manufacturers, and as the demand picks up from more manufacturers of phones, vehicles, agricultural equipment, and all other industries that will require 5G connectivity, Qualcomm should see highly increased revenue figures, as they're going to be able to sell their components at a higher price point to more players that want to benefit from this boom. In fact, the company says that they're even planning to make 50% more revenue per 5G smartphone by charging higher prices for the components, and this is in addition to their main source of profit, which is actually licensing patents to various handset makers and reaping royalties, such as with Apple Computers, which recently just settled all their disputes with Qualcomm, granting them $4.7 billion in settlement fees, and then doing a full 180 and entering a long-term patent licensing and chip supplying deal with Qualcomm, which I don't think this needs much explaining, but any long-term deal with Apple Apple computers is a huge score for any company. In November 2019, Qualcomm even estimated an increase in cell phone chip demand, rising from 175 million 5G smartphones to be shipped in 2020 to 225 million, which is a huge spread and should have a major impact on their revenues for the 2020 calendar year. And we'll be taking a look at if this estimate for 2020 was accurate now that the medical situation has taken a toll on most companies. But let's first take a look at the stock quote to see what we're dealing with here. When first observing the company's 5-year chart, Qualcomm has definitely had some ups and downs over this 5-year period in relation to disputes with Apple and somewhat of a stagnating mobile device industry, as most customers are keeping their 4G devices longer since technology isn't advancing nearly as fast anymore from a connectivity standpoint. Now that 5G is right around the corner though, and Qualcomm is a main player in this space, it's very evident on their website that 5G is really their main area of focus and that they're looking to capitalize on this 5G boom as much as possible. Year to date, the stock is down roughly 11.5%, sitting at a price point of $78.42 at the time of filming this video on Tuesday evening, which is still down around 18.24% since price highs in January and up 28.75% since March lows, so it's definitely followed most of the market patterns over these past couple of months. Market cap is sitting at $88.21 billion with an earnings per share of 3.41 and a price to earnings ratio of 23.02, so nothing really out of the ordinary for a tech company in these respects. Forward dividend yield of 3.23% on a quarterly schedule is actually quite nice to see for a company that will also be able to most likely provide some great capital gains over the coming couple of years, and the stock has been growing their dividend for a consecutive 9 years. The dividend distribution puts it at a dividend payout ratio of 80.52% for the 2020 estimates, which is quite high, so keep that in mind. But we'll now be diving into the company's income statement and balance sheet for Q1 of 2020 to see what we're dealing with. Alright, first taking a look at Qualcomm's revenues from a year-over-year standpoint, the revenues are actually somewhat flat with recent growth in 2019, and earnings themselves are somewhat inconsistent, but from a quarterly standpoint, growth from Q1 2019 to Q1 2020 was 4.70%, so nothing major, but still some growth, which is nice to see. And keep in mind that once 5G chips and technology are heavily rolled out, it's at this point that Qualcomm should see some double-digit growth in revenues quarter over quarter. Other than that, honestly, nothing really stands out to me all that much in their income statement, but I would like to bring your attention to the operating expenses because Qualcomm is a company that spends a tremendous amount of money on research and development, R&D, which we can see at $1.47 billion in Q1 of 2020, which is used to grow their product offering though, so it's expected of a company such as this one. Let's now jump into the balance sheet to see how the company is coping with their assets and liabilities. So at first glance, on a year-over-year basis, the company's assets have fluctuated greatly, with most drastic changes being from their current assets, most specifically their cash position, as we can see right here. And the reason why 2017 is significantly different than any other period is due to the fact that in that given year, the company had a massive influx of cash flows from the maturity of their investments. Now in Q1 of 2020, their total assets sit at $31.94 billion, with current assets of $15.31 billion and $9.95 billion sitting in cash and cash equivalents. When compared to their current liabilities of $9.75 billion, this puts their current ratio at 1.57, which isn't great. Typically, we want to see this above a factor of 2 for a financially healthy company regarding their short-term assets and liabilities. With that said, total liabilities of $28.89 billion. This is quite high considering their total assets and the fact that a lot of their cash and short-term receivables over the past years they've used to buy back shares, as we're about to look at in their cash flow statement. Now looking over the cash flow statement, I honestly don't really love what I see, even though they have a free cash flow of $738 million in Q1 of 2020, which again is really inconsistent with this company. As we can see here, it jumps somewhat all over the place. The reason why I'm not a huge fan of this cash flow statement right now is primarily due to the fact that over the past years, the company has spent excessive capital repurchasing stock, which doesn't do anything productive for the company whatsoever other than raise up the stock price because there are less shares on the open market. For example, in Q1, they spent $1.58 billion repurchasing stock when the free cash flows was only $738 million, and when looking at prior years, they have spent tremendous capital on buying back shares, which I believe could have been put to a much better use as, say, reducing their liabilities, but that's just my opinion. So with all that said, honestly, Qualcomm isn't necessarily the best company from a balance sheet and cash flow statement standpoint, but due to the fact that they are heavily involved in the components required for 5G and have signed a long-term deal with Apple regarding 5G chips, their increased revenues in the years to come could have a major impact on growing share price, not to mention that their dividend distributions are a nice asset to your portfolio. I do want to mention that I personally do not own any Qualcomm stock at the moment, but it wouldn't surprise me if we do see this stock reach the mid $100 range over the next couple of years. Make sure to let me know your opinion of whether or not Qualcomm is a buy for the coming years and what you thought of this analysis down in the comments. And if you're enjoying this video up to now, make sure to smash the like button. Alright, so moving on now to the second 5G stock that we're going to be covering in today's video. This stock in question is the dividend telecom player Rogers Communication, ticker RCI.B on the Toronto Stock Exchange. And if you're Canadian, you're definitely familiar with this company because it's one of the three main telecommunication providers in the country, representing about 32.4% of Canada's wireless telecom market as of 2019. Now, since this is the only Canadian 5G stock that we are going to be covering today, let's take a moment to speak about the impact 5G technology will have on the Canadian economy as a whole, not necessarily only for Rogers Communications. 5G is expected to have a massive impact on job creation and growth of GDP in Canada, with forecasts of $40 billion being injected into the national GDP and 250,000 jobs being created, which are staggering numbers and really positive news for the country. Back to Rogers now. This is the first Canadian telecom provider to officially turn on its wireless 5G networks in metropolitan areas throughout the country, starting with Toronto, Ottawa, Vancouver, and Montreal, with plans of expanding this network to roughly 20 Canadian cities by the end of 2020. The reason why I chose Rogers for this video over, say, TELUS, which is also rolling out 5G networks across the country, is because Rogers actually has better financials, better ratios, somewhat of a better balance sheet, and is using Ericsson 5G technology rather than Huawei, such as with TELUS, which has many individuals on edge regarding information security if using TELUS's network once 5G is implemented with Huawei technology. Looking at Rogers' stock quote, the last price was around $56.87, and the market cap is just under $30 billion at $28.795 billion, with a price to earnings ratio of 14.71, which when compared to TELUS at 16.78 is actually significantly lower, and their earnings per share is 3.89, which is much higher than TELUS at only 1.37. The forward dividend yield is nice at 3.51%, putting it at a dividend payout ratio of around 51.39% of the trailing 12 months, which is a nice and manageable dividend payout ratio. The stock is down roughly 11.88% year to date and is down around 15.20% since February price points, and even now I think this could be a long-term buy and hold. In fact, even though the growth estimates for revenues are forecasted to be negative 16% in the current year, next year growth is estimated at 18.40%, most likely in correlation with 5G implementation. Let's now take a look at the Rogers income statement for Q1 of 2020, but also for 2019 and prior years to get a sense of the company's growth. Q1 2020 revenues are $3.415 billion, which is actually down 4.7% since Q1 of 2019. And when looking at year over year from 2016 to 2019, the company has seen some growth and stagnation in revenues more recently, but cost of revenue has declined in 2019 from 2018, making operating income somewhat stagnant. Honestly though, for such a large and established established telecom company, everything else in the balance sheet is relatively standard and nothing really stands out to me all that much. The lowered sales in Q1 2020 are directly related to the medical issue, with a 17% decrease in wireless equipment sales due to the medical situation, but should pick up over the next couple of years, especially with the 5G implementation and a growing customer base. Now that we've taken a look at their income statement, let's dive into Rogers' balance sheet, which is considerably strong in the Canadian telecom space, coming in at $40.076 billion in assets, with $6.343 billion of those being current assets at $1.936 billion in cash and cash equivalents. The company has put significant emphasis on increasing their cash position from previous quarters, which I do like to see in a period such as right now. Their current liabilities are sitting at $5.748 billion, putting their current ratio at 1.1, which I'll admit is definitely much lower than I would personally like to see from a company during a financial climate such as right now, and a large portion of their non-current assets are comprised of goodwill from purchasing other companies, which is a soft asset and really isn't all that tangible. Overall, this balance sheet is quite similar to TELUS and other large Canadian telecom providers, and even though the current ratio is quite low, this shouldn't have a major impact on the company's operations and dividend payments throughout the rest of the year. And finally, the company's cash flow statement. Now, operating cash flow in Q1 of 2020 has taken somewhat of a hit since last quarter and is also down since Q1 of 2019, but again, this is due to lower revenues as we saw earlier. The most notable element in Rogers' cash flow statement is their focus on financing cash flows, where they issued $2.83 billion in long-term debt in order to raise their cash position, which I honestly think that right now in this financial climate, it is not a bad thing to have significant cash on hand, and this allowed them to pay back $1.47 billion in short-term debt while still raising their cash position by nearly $1.45 billion quarter over quarter, which I really like to see. All in all, it's clear that Rogers is temporarily hurting due to the medical situation, such as most companies are right now, but Q1 earnings aren't as impacted as what was projected for the company, and with the company being the first to launch 5G in Canada, I could very well see Rogers continuing to expand their network and client base over the coming years, and I believe that the current stock price is quite pessimistic. Let me know down in the comments if you own any Rogers stock or any other Canadian telecommunications company.
So what are your thoughts on today's video, and are you excited to see 5G being rolled out in the near future? Let me know down in the comments. I'd love to start up a conversation with you, and I know we only had time to cover 2 stocks related to 5G today, but if you want to learn more about 5G stocks, or you'd like me to cover a couple more in the near future, then let me know again down in the comments that you'd like to see more 5G related stocks. With that said, most 5G related stocks are American, so I just want to put that out there. If you're interested in learning more about stock market investing, then I highly recommend you check out one of the 2 videos that I'm overlaying right here. And if you enjoyed today's video, make sure to smash the like button. It really helps my channel grow. So on that note, thanks a lot for watching, and I'll see you in the next one.